Good evening, everyone. Welcome to our special presentation tonight, Credit Spread Mastery Series Overview. And this is featuring something we call the layered credit spread. This is different than any particular credit spread you may have ever heard of. All right, glad to have all of you here. My name's Tom Gentile. Obviously, you know me. But my special guest tonight who does this day in and day out. This is his, I like to say that in trading, you want to be a jack of all trades or the master of one or two. This is what Devon masters in, is that's layered credit spreads, and he's going to be talking about this tonight. Devon, good evening.
Hey, good evening, everyone. How are you doing?
I am great. Glad to have you here. Is it not the perfect time to be discussing this right now?
Well, Tom, tonight was no accident. I tell you that much. We are right here. We're actually 43 days before April's expiration, 44 for standardized options, but 43 for some of the index options. So, Tom, I love looking at credit spreads at, right there, close to that 45 days before options expiration. So, really Monday through today is the perfect time to go out there and start our first layer. Now, that kind of insinuates that there might be a second, a third, and a fourth, whatever a layer is. But, we're going to learn a lot tonight, folks. Not only are we going to talk about the current markets, but we're going to jump into, really how to diversify risk, reduce risk, I should say, by diversifying multiple credit spreads on just one or two markets. And we're going to roll up our sleeves and even find a couple of high probability trades and just kind of keep you hanging a little bit. Tom, let's define what high probability in the credit spread world is. So high probability is a minimum of a 92% trade, 92% probability of that credit spread staying out of the market. Now, I will explain more on that as the next hour and a half or so goes, but that will be a measured probability, not something that we put a number on and kind of guess and do a little roundabout wishy-washy thing. I mean, that is a measurable probability of 92%. That's what we're looking for, or higher, or higher.
That's awesome, and I know everyone in the room is anxious to get into this. Before we do, however, Devon, if you could flip that screen for me, and
You got it.
and I'm going to get into this in just a second. But keep in mind, guys, this session is being recorded. We will get the recording out to all of you as soon as we can after the live event is over. Also, I've got Jay Harris, who's in the room with us too. Jay, good evening. How are you today?
I'm doing really well, thanks.
Awesome
Appreciate being here and
awesome as
helping
always.
everybody out.
Jay is going to be handling the boards, so that's the other thing I want to mention to you before I get into the disclaimer. If you have any questions tonight, all right, feel free to put them in the Q&A box. We will get to as many as we can. I will let you know right now we have a lot of people that have jammed into this seminar room tonight, so keep in mind, I'm going to apologize to you right now if we don't get to your specific question. We will answer as many as we can, taking into account the ones that are more popular are going to be the questions that we ask and answer. Finally, this disclaimer you see on the screen here. All right, I put this on every single webinar that we do. It is there obviously for me and for you. You can read this in its entirety in the recording that you're going to get shortly after this live event. Let me just point out a couple of things. Number one, any of you in the room that are option traders know this. Stock and options trading has large potential rewards, but also large potential risk. All right. The other big thing is that me, Devon, Jay, and anyone associated with Tom's Trading Room LLC, we're here as your educators. All right. We're not brokers. We're not investment advisors. We don't give specific or personalized investment advice. You need a broker to trade with. You must meet certain requirements. And everything Devon's going to talk about tonight is in US dollars unless noted otherwise. So, Devon, it is all yours.
Hey, all right. We have a lot of information to cover here this evening, so let's jump right in. So for those of you that don't know me, by the way, we have a packed house. This is incredible here. For those of you that do not know me, I've been involved with the markets for a little over 20 years. I used to manage a direct access trading firm, which is a politically correct way of saying a day trading firm. I have traded stocks, I've traded options, I've traded futures, I've traded and invested in just about everything over the years. And, back in the old days when I was day trading, sometimes, with stocks and options, sometimes I would trade 25, 30, 35 or more times per day. And I remember one of the things that my father taught me years ago. He said, son, stop working hard and start working smart. And I thought I was working smart by trading some of my own money, right, to generate income and grow my accounts. But the reality is I was sitting in front of a computer for the entire market duration, plus doing research, which equaled somewhere between 8 and 10 hours per day. So, was I really working smart back in those days? Sure, I was making a little bit of money and had some freedom to do what I wanted to do, but I was also trading 10 hours a day to do so. I was trading time, I was trading money, and I was trading financial risk. That doesn't sound too smart to me. So over the years, I've really made it my goal to, truly learn what it means in the stock and the options market. Tonight, very specifically with the options markets here, to work smart. What does it mean to work smart? And I've put together a system that, really allows the average person to go out there and live life, work, and do what they want to do. And this particular system we're talking about here should take no longer than 1 hour per week, okay? And once you get good at it, 15 or 30 minutes per week, not per day, but per week, to manage and find new high probability trades. In fact, folks, tonight we are even going to go out there and we are going to find a couple of high probability, 92% minimum probability trades this evening. And I'm going to step out on a limb here. I'm going to say we can do it in less than 1 minute, all right, to find a couple of those, two of those. So you're going to time me. We're going to see if we can actually do it. You're going to start to see how we can put together and find and manage these opportunities in a very short period of time. So we're going to start off with a little market outlook. We're going to cover some of the credit spreads basics and jump into what layering is. I have lots of examples to share with you. Do an overview of the most important part of my trading system, which is the money management, and then talk about what to expect next Wednesday, the start of next Wednesday, March 15th, with my Credit Spread Master Series coaching class. I know so many of you on this call here this evening are already registered for that, and we do have a few open seats as well, as I do teach this particular workshop just one time per year, and it's coming up right now. So we're going to start it tonight. These layered credit spreads that we find this evening are going to carry right into next week, and then the week after and the week after, we're going to build some layers around this for April's expiration, and then even work our way into the month of May. So let's start off here by doing a little market review. This is fun. So let's switch over to a basic chart of the Dow Jones, okay, as what you see on the screen right now. Very, very basic chart. There's a couple of moving averages on this particular chart. We have a 50-day moving average as well as a 200-day moving average. The markets are well above these moving averages. Ever since November the 8th, the markets have been like a rocket ship, as Tom stated here. Over the last week, a couple of weeks or so, we've seen, are we hitting the ceiling? Don't know. But when we were hitting that 20,000 mark, we were hitting it for a long period of time, and it busted up to 21,000. And I've been asked countless times over the last couple of months, Devon, where do you see the markets going in the future? The next 30 days, next 60 days, the next year, at the end of 2017, where do you think the markets are going to go? And folks, I want to cover that first. I think it's important. It is important. So folks, I'll be honest with you. With doing my extensive research and looking at other things that I'm not showing you here on the screen, I have absolutely no idea what the markets are going to do moving forward. I mean, not a clue. Maybe they'll go up, maybe they'll go down, maybe they'll go sideways. Who knows, right? Now, before all of you say, wow, I'm going to log out of this class, this instructor has no clue of what the markets, no feel of what the markets are going to do moving forward. Okay, before you do that, let me explain myself here just a little bit. Now, yes, I kind of have a little hunch of what I think the markets are going to do for 30 days to the end of 2017 that I do apply to my directionally based trading systems and investing systems. But for trading credit spread layers, here's the thing. We don't need to know what direction the markets are going to go. In fact, sometimes, most of the time, looking at market direction will actually hinder this trading system. So what I'm going to share with you here is how to not look at the chart, to not care about the chart, and simply look at probabilities and learn how to trade what I call bullish. Bullish and bearish at the same time, regardless of what the markets are doing. And then if we get some sort of extravagant move like we had going into December, then we'll simply make an adjustment when our probabilities drop, when the measured probabilities drop. So there's no more thinking. We're going to take that emotion completely out of this trading system, and we're simply going to react and manage appropriately. Okay, more on that as we continue here. Let's jump right into credit spreads, the basics of credit spreads. We have a bull put spread and we have a bear call spread. All right, these are two different spreads. Now, a bull put spread, now we'll break down the individual components here in just a couple of minutes, but even before that, a bull put spread, a lot of folks will say, is a bullish strategy, and that's really not correct. If these are positioned what's called out of the money, which I'll share with you here in just a minute what that means, it is a semi-bullish strategy, meaning that what we really want the markets to do is stay above a certain level. In some regards, the markets can actually pull back a little bit. We can be wrong on market direction a little bit. Let me repeat that. We can even be wrong on market direction a little bit with a bullish strategy. We can have the markets go down with a bullish strategy and still make a profit. That's one of the reasons I love trading credit spreads, because we can really have a market that moves what I call 2.5 directions, and we can still be profitable. Same with our bear call spreads. It's not a bearish strategy if it's positioned correctly. It's a semi-bearish strategy. We want the markets to stay below a certain level. Now, Tom, before we go into the basic construction of spreads and individual, looking at the individual credits and so on, do you have that first poll question ready? I want to ask the students, I want to kind of get a feel of where our students are at here.
Yeah, here we go.
All
so,
right. Tom,
so the first one is, do you know what a credit spread is? This is the part where you come in and you select one of the following. Either the first button, never heard of them. Number 2, does this involve credit default swaps? Number 3, heard of them, never used them. And number 4, I know credit spreads and I trade them. So pick one and click on submit. All right. About half of you have already buzzed in with your answer. I'm going to give you a few more seconds here to get this. And really what this does is this gives us an idea of what the room has. And keep in mind, we're not going to display your individual vote. What we're going to display is the overall vote in terms of a percentage. What percentage have never heard of them? What percentage have heard of them, never used them? What percentage knows credit spreads and trades them? That's why we take the vote. We're going to do 3 of these tonight. This is your first one. All right, so you have the opportunity as our bulk audience to be able to answer these. All right, I'm going to go ahead and close the poll. So
right,
here we go.
We're at.
Close poll. Let's share the results with everybody, Devon.
Yeah, let's do that. Let's do that. And with these poll questions, don't overthink them too much here. Just want to get an idea in terms of how to pace my class here this evening. So, all right, so 13% of you have never heard of them. Let's address that. I don't want you to feel like you're at a disadvantage because you've never heard of a credit spread, or you don't have any experience with them. There's 33% of you that have never used them. In some regards, that's actually better because that means you don't have any bad habits yet that are created and that we need to correct. So we'll walk you through the basics here in just a couple of minutes. 54% of you know what credit spreads are and trade them. So, I mean, really, Tom, we have a mixed group here where almost half of the group, has incorporated credit spreads to some, way, fashion, or way, shape, or form, and about half of the group has not. Okay, and with a different experience level. So, all right, fantastic. Let's go ahead and jump forward here And thank you, by the way, for participating in that. As Tom said, we will have a couple more questions as well. So let's take this basic market. This is a market that's priced at approximately $600. And the green area here that I just put on the screen is going to represent where we are going to position a bull put spread. The red area is going to represent where we are going to position a bear call spread. So when we start the basic construction, what we're going to do is this. We're going to pick an area, all right, maybe down here at a price of $540. Okay, more on the specifics of the area in just a little bit. But we're going to start off by selling a put option. Now, some of you may know when you sell a put option, you are taking on the obligation to buy the underlying security at a specific price, on or before a specific date. Can be risky. Okay, many people say it is. We're going to alleviate a good majority of that risk as well as capital needed to position the strategy by turning this into a credit spread, and we're going to do that now by buying a put option at a lower strike price. And the combination of these two actions, or these two option legs, selling the put and buying the put, creates that credit spread. So if we were to create this credit spread at a price of, or strike price rather, of $540, let's just say that it returns a 10% ROI, or return on investment, return on the amount of money that we're putting up for this particular credit spread. What that would mean in the practical world here is that as long as this market stays above this price, $540, for the next, until options expiration, then this particular trader would make a 10% return on investment. Okay? Well, again, the amount of money that we're putting into this trade. So if you put up $1,000 on this trade, which might represent one or two contracts depending on the market, then 10% of that. If it's $5,000, 10% of that. $100,000, 10% of that. You guys can kind of get the idea. Now, we can match this up with another trade up here, maybe at a price of $640. Okay, strike price of $640. This is called a bear call spread. Now, we position these first by selling a call option and turning right around and buying a call option at a higher strike price. Now, we want just the opposite on this bear call spread. Again, it might create a 10% return on investment, maybe a 5% return on investment, maybe a 25% return on investment. We'll talk about that more so here in just a couple of minutes. As we create this bear call spread, we want the markets to now stay below a certain range. Now, one of the ideas that we're going to get into here this evening is if we create both of these, okay, not given a rat's furry back end about what the markets are doing. Now, essentially what we're doing is saying, hey, let's position both a bull put spread and a bear call spread. Some of you have known this as an iron condor. Okay, if you don't know what that is, that's okay. But as we create both of these spreads together, now we want the markets to stay within a large trading range. And as long as they do that, then we can make a, for example, 10% return maybe on both sides of the market, maybe 5 or so on. Let's go into, let me switch over to my tablet computer. Now let's go through some specifics here. Let's say that we have a stock that's at a price of $47 per share. So let's go out there and build a credit spread, let's say at a strike price of 45. So the first thing we would do is sell a put option, a $45 strike price put option. Let's make up some numbers and just say it has a total value or credit of $4. We create this credit spread now by buying a $40 put option at a total cost of $3. So if we receive 4 and spend 3, then we have a total credit, all right, of $1. Now, this credit can also be called a max profit, maximum profit. This $1 is not going to show up in your trading account immediately. It's something that is going to develop over time, going into options expiration. So as we construct this trade and we receive this maximum profit or credit of $1, what we want, we get to keep this $1 providing that this stock stays above $45 per share, okay? So let's say that this is a stock that we think is going to go up to 50. Maybe we think it's going to stay in the sideways trading range near $47. Let's say we're somewhat bullish on this. Okay, here's an example of where we can be wrong by a little bit. We can be wrong by $2 per share and still make a $1 profit. Now, if we were to turn this into a return on investment, I don't want to get into all the specifics right now of the basic options construction, but what we would do is take the difference in strike prices minus our credit received, which would mean that our total risk on the trade would be $4, okay? Now, some of you might be thinking, okay, Devon, why in the heck would you, okay, why in the heck should I risk $4, right, to make a $1 profit? Well, first off, if we were to do that and take 4 into 1, that would be a 25% return on investment. Why should somebody do this? Now, the answer to that is because of the probabilities. We have an inverted reward to risk ratio on the trade, but we're only taking that inverted reward to risk ratio because we're going to be looking at a minimum of a 92% probability on all of our credit spreads. Now, with that being said, yes, technically we have risk of $4. Now, let's talk about buying a directionally based stock, okay, and the word technically, right? Over here in the lower left-hand corner, if we were to go out there and buy a stock like Starbucks, all right, Starbucks is trading roughly $55 per share, right? So if we were to buy Starbucks at $55 per share, technically speaking, right, if we buy 100 shares, $5,500, technically how much money do we have at risk? Well, technically, we have $55 or $5,500 at risk. Now, those of you that have a little bit of a trading background or even investing background know that if Starbucks goes into a catastrophic drop, right, we would have some sort of a stop loss in place, maybe a physical stop loss, maybe a protective put for some of you that understand how to match up puts in terms of reducing risk and losses on directionally based trading opportunities. But my whole point is we're not going to risk that entire $55. And the exact same is true with our credit spreads. We're not going to risk that entire $4. We're going to implement some sort of a money management technique in place here. Now, which we'll get to here in a few minutes. Now, for those of you that don't understand the basic construction in its full or even have experience placing orders with this, Tom and I have put together a little recorded video. I've already recorded this. It's just a little bit less than 1 hour in length, where I go through a number of different examples of bull put spreads and bear call spreads, go through the exact numbers, and even go into learning how to place these orders by looking at an option chain and exactly learning how to facilitate a credit spread opening position and a credit spread closing position. So those of you that are already registered for my 5-week workshop that officially kicks off next Wednesday, Tom is going to email that out to you here in the next couple of days. And this is what I call my little credit spread options primer, where I'm going to spend a lot more time than what I am here this evening going through the basics. So if you're a little bit lost right now, that's okay. Okay, just know that for those of you moving forward with the Master Series workshop, online workshop, you're going to get that options primer, and we'll spend a lot more time so you'll really have the basics cemented before moving any further. So let's do this. Tonight, I really want you to understand more of the mindset than the specifics of understanding a basic credit spread. And a couple of the reasons for doing that. Number one, the mindset's more important, quite honestly. And number two, placing a credit spread is so incredibly easy to do with most of your brokers, you know, whether it's TD Ameritrade or Options Express or E-Trade or Thinkorswim, which is a subsidiary of TD Ameritrade. They make it so incredibly easy to do, you really don't even know which options or strike prices you're buying or selling because it's calculated automatically. In fact, in that 1 hour video, it's really overkill on learning how to place those orders. So let's talk a little bit more about mindset. And let's take that exact same example that we just did. I want to illustrate this, however, on my tablet computer. So let's say that we have that same stock at a price of $47 per share. All right, I like to represent credit spreads as a bar. All right, so here's our bar. And here's what we know about this bar. This bar goes up to a price of 45. That was where the credit spread was sold at. This bar has an expiration on it. And if we look at current options today, that expiration is April the 20th, or at least on the market that I'm going to introduce you here to this evening. On most options, stock options, the expiration is actually on the 21st of April. On index options, it's going to be on the 20th. Okay, a little bit more on that here in just a couple of minutes. So we have this bar, and there's two numbers that are very, very important with this bar. Okay, one is return on investment, and the other is probability. Let's just make up some numbers right now. Okay, we're going to look at some very specific actual numbers in just a couple of minutes. So let's say that this particular credit spread has a 25% return on investment. Okay, exactly as I just illustrated, right? And let's say that it has a measured probability of, we'll just put prob for short, measured probability of 75%. Okay, that means that this particular trade, this particular credit spread, has a 75% probability of staying above $45 between now and April the 20th, right? And if it does, then we have the opportunity to make a 25% return on investment. Now, with this credit spread, we can move it. We can move it higher. We can move it lower, right? We can move it to a riskier position on the chart. We can move it to a safer position on the chart. For example, let's say that we were to take this bar and move it to a lower level. Okay, so let's just say that the top of that horizontal line is gone. And let's say we move this credit spread down to a level of 40. That's going to be now our sold put option, okay? So what happens if we move this down to a level of 40? What's going to happen with our probability? Well, now stock's at $47 per share, right? Now it does not need to stay above 45. What needs to take place is that this stock needs to now stay above 40. So our, let's call it our flux factor, the amount that the stock can fluctuate, has now increased. So our probability has gone up. And let's say that our probability has gone up to a level of 92%, right? So now we have a 92% probability of this stock at 47 staying above $40 between now and options expiration, which is April the 20th. Now, if our probability increases, what do you think is going to happen with our return on investment? Well, our return on investment, as probability goes up, okay, our profit potential, return on investment, is going to drop. And let's just say, hypothetically speaking here on this example, our return on investment drops down to a level of 8%. Okay. Now, by the way, I'm looking at these numbers here, and I realize that 25 plus 75 equals 100, and 8 plus 92 equals 100. That is a coincidence. These two numbers do not always equal 100. In fact, very seldom do they equal 100. So what we're going to do in trading, the art of trading a credit spread is really a mix between finding a high probability, a probability that you're comfortable with, as well as finding the amount of money that makes it worthwhile for you trading. Okay, so that's what I really want to focus on here this evening. Not exactly where the strike prices are, because that options primer video is going to walk you right through that, and it's very easy to understand after you place a couple of paper trade orders. Let's just look at the mindset here this evening. So let's switch back over here to our slides, and right there they are. And let's jump forward and let's take a look at some real numbers, okay? So let's take a look at some data. Let's take a look at a return on investment, ROI, with the Russell, okay? Russell 2000, ticker symbol is RUT. You're going to want to write that down. Now, I have 1, 2, 3 examples to show you here this evening, plus one that we're going to go out there and find ourselves. So I've got 4 examples really to show you this evening, okay? First one I'm going to show you is on the Russell. The second one I'm going to show you is on the Russell. The third one I'm going to show you is on the Russell. The fourth, you see a pattern here? The fourth one I'm going to show you, the one that we're going to find together, is going to be on the Russell. Ticker symbol is RUT. Now, why is that? The Russell offers the highest probability trades that pay the most amount of money. All right, now I can prove exactly what I'm saying here. Let me say it again. The Russell offers the highest probability trades that pay the most amount of money. Now, let's think about this. Why do you buy a stock? Why do you invest in a mutual fund? Why do you buy an investment piece of real estate, maybe a rental, okay, or fixer-upper, okay? Why do you invest in an investment? Well, the answer to that is quite simple, right? If I may speak for you, I believe the answer is to make money, right? You buy a stock, you buy a mutual fund, you trade options because you want to make money. Is that correct? Now, if that's truly correct, which I believe it is, then let's start looking at this from a business standpoint and start looking at, since Devon's talked about probabilities, let's talk about where do we have the highest probability in making the most amount of money in the shortest period of time, right? Let's take this to the next level, and the Russell has it. Now, one of the things that I've done over the years is try to find the absolute best market or two to trade credit spreads on. I've traded a lot of different markets over the years. I've looked at a lot of data, and I've put together a little comparison, a way, I should say, to compare the Russell to the S&P, the Russell to Amazon, right? The Russell to Apple, the Russell to the gold markets or the silver markets. And if you look at the probabilities and the payouts and the ATRs or the average trading ranges, the Russell has currently and has for the last, quite honestly, about 7, 8 years, has on average offered the highest probability trades that pay the most amount of money. Now, one of the things that we're going to do next Wednesday, in fact, this is one of the very first things that we're going to do, is we are going to together build an ATR worksheet, an average trading range worksheet. We're going to compare the Russell to a market that you might be familiar with, a market that you might be interested with. This is going to go from next Wednesday to the following Wednesday. Part of it's going to be a little bit of a homework assignment because I want you to roll up your sleeves between classes and do a little bit of work yourself. And I'm going to have you send it directly to me on my discussion board so I can do some calculations and then show you exactly how to do this. And the reason for that is, there's 2 reasons actually. Number one, I want you to know without a doubt that right now the Russell is the best place to park credit spreads at. Number 2, and more importantly, is I want you to have the knowledge to find the highest probability markets to trade credit spreads on, because in the future, maybe 2, 3, 4, 5 years, maybe next month, who knows, if the Russell falls out of favor, then I want you to have the tools necessary, the education necessary to go out there and find the highest probability markets, because that's why you're here, right? To make money, we need to start looking at the highest probability markets. That's what Tom's done with his trading tools. He's put together some awesome trading tools, and he has filter upon filter upon filter upon filter to find the best of the best of the best, because he doesn't want to waste his time with B trades or C trades or even A- trades. He wants the A++ trades. Start with probabilities. In fact, I would write that down. Start with probabilities. Regardless of the trading systems, start with probabilities. Now, we're going to look at this first example. It's going to be 45 days to options expiration. As Tom mentioned, this class is not an accident why it is tonight. We are just about 45 days before options expiration in the month of April. That's very strategic. We want to create these layers between 20 and 45 days before options expiration. Now, this first chart I'm going to show you, let me just get it on the screen so you can have something else to look at while I'm talking. Okay, we'll build some trades on it in just a minute. This first example is, I don't know, 3, maybe 4 years old. The next example I'm going to show you is 2 years old. The example after that is going to be 1 year old. The example after that we're going to find together, it's going to be 6 hours old, 5 hours old. I mean, it's today, right? So and the reason I'm walking you through multiple years of credit spreads on the Russell is I want you to see the consistency of the quality of these trades. Because it's one thing for an instructor to say, hey, look at this trade. It's beautiful. It's awesome, right? Yeah, you may not see it again on this market for a couple of months or years, but hey, it was a good one, and darn it, you missed it. The thing is, folks, what I'm going to show you here tonight, these types of trades they present themselves virtually every day. Okay, now they don't present themselves every day, but almost, okay, virtually every day of the year. And there's more opportunities than any of us have money. And that's what we're going to do is we're going to focus on just one or two markets. And most of my students just focus on one market. There's a lot of opportunities on the Russell, and they happen to be the best on average of any market that's out there. So let's start here. This particular chart is at a price of $590, okay? Now, this is the Russell. This market is at $590. Let's take a look at our first credit spread. Again, we're not going to look at the specifics of the individual spreads, okay, or strike prices. I simply want to look at return on investments and where these credit spreads are being placed at. That options primer will talk to you more or discuss more of the absolute basics of strike sold and strike spot and so on. We will also cover some of that next Wednesday as well in a little bit more detail. So we have the strike prices of 530, 540 to create this bull put spread that pays a 21% return on investment. Now, this particular trade at the time had a 78% probability of being profitable. Now, what that means is on this particular trade at 590, it can go down $50. Okay, it can go sideways. It can go up to a gazillion. As long as this particular market, the Russell, stays above a price of $540, we can make a 21% return on investment. All right, so let's say that again. Maybe this stock or market rather has been in an uptrend, right? Maybe we think it's going to continue up. If we position this bull put spread, we could have made a 21% return on investment. But if we're wrong, we can be wrong by $50 a share, 50 points, and we can still make a 21% return on investment. Not too shabby. Now, I'm kind of saying a couple things here 2 or 3 times in a row because I want you to see a theme. The theme is, hey, let's learn how to still scratch out a profit even when we're not right on market direction. All right, and let's face it, how many of you have said, hey, the market's going to go up this year, or the markets are going to go down this year, or this month, or next month, or this week, or this day, and been wrong? Statistically, folks, okay, I mean, good traders are right 55% of the time. Thereabouts, just a little over 50% of the time on market direction. Now, if we're statistically not good at picking market direction, and statistically most of us aren't, okay, then hey, let's not get down in the dumps over it. Let's take lemons and turn them into lemonade and learn how to position trades where we can be wrong and still make money. Because it's not about being right or wrong at the end of the day or end of the year. It's about making money, right? I mean, I don't care if I'm wrong on every trade. If I could still make 21%, sign me up, okay? Now, it's a good trade. It's not what I call my goosebump trade. Okay, goosebump trades, when you look at it and say, Devon, that trade looks so good, looks so juicy, why would somebody pass this up? Hey, let's work into it. Let's take a look at another example, same chart, same time frame. Here's a credit spread down here at the strike prices of 500, 510. Now it pays an 11% return on investment. So as the trade's getting safer, okay, let me fly in the probability here. As the probability is increasing, our return on investment is dropping, okay? So now, even though we have the potential to make about half, what have we done with the safety factor? Well, this Russell's at a price of 590. Now we're positioning a market down here, or a credit spread rather, down here at $510. So we can be wrong now, not 50 points, but we can be wrong now 80 points and still make an 11% return on investment. The trade quality is getting better. Would you all agree? Now, let's take a look at what I call a goosebump trade. All right, here's a goosebump trade. Probability has now jumped above 92%. Okay, 92% is the threshold. This case here, we have a 93% probability. Now, the payment on this, the return on this particular trade has dropped down to 5%. But I want you to understand this. Okay, we only get to keep this 5% or 11% or 21%. We only get to keep that percentage. We only get to keep the credit as long as the market stays above our credit spread, our bull put spread, okay, or below our bear call spread for our bearish type of the trades. We'll talk more about those on the next slide, okay? So now, take a look at this. The Russell's at a price of $590. It can go down to 480. So that is, what is that, 110 points? Let me do some math here. If we take 110 points, divide that by 590, it's going to give us a percentage of 18.6%. So let me reword what I just said here. If we position this bottom trade, this bottom credit spread, okay, at this time in history, the Russell can fall 18.6%, and a trader could still make a 5% return on investment. Now, how's that? How's that for your stress level? I mean, it almost just feels easier to breathe at just saying that, doesn't it? I mean, think about that. You could be wrong by 18.6% on market direction and still make a 5% return in 45 days. Now, I know what some of you are thinking. Some of you might have a little experience with this and say, yeah, but Devon, what if the markets fall 18.7% and go down below a price of $480? Then you're hosed, right? And the answer to that is it depends. It depends if we just sit back and let ourselves get ran over by the train, or if we take a proactive approach and do something with this spread. Maybe we even learn how to buy insurance on it. We'll talk about that in a couple of minutes as well. Now I'm really getting goosebumps, okay? Because, you know, the truth of the matter is this, folks. Finding these high probability trades, you'll know how to do this by next Wednesday. I mean, it really doesn't take me that long to teach you. It's really quite simple, actually, especially when I show you what I put together with Tom to automate the whole thing. Even doing it by hand, it's not going to take much more than 15 or 20 minutes. That's the easy part. Yes.
If I can interject right now, the predominant question you have coming in is primarily whenever you say probability, is they're asking how you're calculating the probability. And I keep answering.
Okay, well, we'll get there. Yeah, we'll get there. We'll get there.
I just wanted to assure everybody in case they're asking, and to those that have
sure. No, I appreciate that. You know, the short answer is this, Jay. The short answer, but we'll get there. The short answer is there's two ways to do it. Okay, number one is we can look at the options delta, which historically measures the rate at which the options change compared to the underlying security. We can look at the options delta and convert that to probability. Okay, that's one way to do it. The second way we can do it is use a fancy options probability calculator, which Tom has on his site, and it'll do it for us. So there's two ways to do this. And you know what, we'll take a look at a real option chain here when we find a trade, and we'll discuss that a little bit further detail, okay? So, all right. So this market can drop 18.6%. We can still make a 5% return on investment. I like that. The key to this, however, is learning to manage the trade when the markets drop more than 18.6%. Okay, let's take a look at some other trades, and let's start incorporating both a bullish and a bearish trading opportunity. Here is an example from 2015, so a couple years old. Now, this spread is created up here. This is the bear call spread. We'll put BCS for short. The bull put spread, BPS, down here on the bottom. So now, taking it up just a little bit here, we're starting really to layer, I mean, to some degree, to the really, really smallest degree here. On this bear call spread, the spread up on top, we want the markets to stay below a strike price at 1,270. This bull put spread down on the bottom, we want the markets to stay above a level of 1,030. Now, we have a return on investment of 5.8% on the bottom and 5.4% on the top, right? We add the two together, and you know, we can call it 11%. You know, we'll just round, okay? That's approximately 11%. we have a 92% probability of this market at approximately 1180, a 92% probability of the market staying above that level, and we have a 94% probability of the market staying below 1270. Now, for those of you that enjoy technical analysis and support and resistance lines, are we also well outside of pretty much every major support and resistance level over the course of the last 2 years? So a trader can position this and have it about 11% return on investment over 31 days, providing that the market stays inside this ginormous trading range. Now, you know what I want to do, Jay? I want to do a little bit of math, and I'm not very good at math, but you don't need to be to do this. If we take 1270 and 1030, that is, correct me if I'm wrong, but that is 240 points, okay? So we want the markets to stay within a 240-point trading range to make a combined 11% return on investment. Now, if we take that 240 points and divide that by 1180, okay, where the market's currently at, that'll give us a flux factor, and that's a term I made up, by the way. 240 points means that the markets essentially can fluctuate 20.3%, okay, up and down, and a trader can still make an 11% return on investment. Now, at the beginning part of this evening here, about 45 minutes ago, when Tom introduced me and I talked about the markets, and I said, hey, folks, let me fill you in on my little inside technical analysis here. My market prediction is I have not a flippin' clue of where the markets are going to go over the course of the next 30, 40, 60 days or longer. And that's really true. I mean, deep down, I really don't know. Does anybody? I mean, honestly, does anybody? And now, do I have to? I mean, think about this. The markets, folks, can fluctuate 20%, and we can still scratch out a profit. Do I need to predict market direction? Now, what do we do back in January when we turn on CNBC and say, oh, shoot, the Dow's up 200 points? Or we go back to October, oh, doggone it, Jay, the Dow's down 300 points. Oh, man, I wonder how my directionally based trades are doing. Now you have a different attitude. You say, tomorrow morning the Dow's down 300 points. Yeah, you know what, Devon? You bet I will. You bet I'll go down to Starbucks and have a cup of coffee with you and enjoy the morning instead of worrying about and freaking out about my directionally based trades. Right? It's a different way to trade.
Yeah.
It's a much freer way to trade. Stress-free way to trade. Yeah, sorry, Jay, I'm getting a little carried away and excited here.
No worries. Questions coming in as to why you're combining the ROIs when they're calculated separately.
Okay, very good question. Now, in the options primer, we'll talk more about that. The reason that I'm combining ROIs is because with most brokers, and this is a little bit more advanced, so some of you may not understand exactly what I'm saying, but with these return on investments, with most brokers, when you position what's called an iron condor, okay, combination of, an iron condor is a very, very fancy way of saying this is a combination of a bull put spread and a bear call spread. Now, most brokers, this is, and I will say the fine print, when I combine the ROI, it's not going to be applicable to every broker that's out there, okay? Most of the brokers do what I'm going to talk about right now, okay? Most of the more popular options-based brokers do calculate margin this way. So they see it. If we position a bull put spread, this bottom spread, bear call spread, the top spread. Think about this. If the markets go up and we lose on one, are we guaranteed to win on the other? And the answer is if we don't make any adjustments, we don't touch it, the answer is yes. So most of your brokers, if you position a bullish and a bearish trade, will only make you put up money to hold just one of the two trades. And it's called, the technical name for it's called double margining. All right? And this allows us to, it actually allows us to actually do better than combining our ROI. But anyway, I talk more about that in the primer. We'll talk more about that next week. But that's how that takes place, okay? Very good question, Jay. I want to take a look at some other examples here. Otherwise, this is going to get turned into a 15-hour class, and I'm so ready for next week. I just love talking about these. Folks, here's another example. This was from last year, exactly a year ago, 30 days to options expiration. A bull put spread down here to strike price of 970. This gives us our probability and return on investment. Another one up here at 1150, a bear call spread, same thing. And the consistency between how far these spreads are out of the money or the flux factor, if we look at the difference between 1150 and 970, we look at that trading range, that is approximately, that trading range is approximately 180 points. And if we take 180 divided by 1,066, that means we have a 17% flux factor, right? And now we're getting to the point where it should be an FFB, not just an FF, but an FFB, right? It's a flux factor baby, all right? I mean, the markets can move, fluctuate 17% up and down, right? Now, if we do the individual math, it'll be a little bit more on the put side, less on the call side to equal 17%. But the point is, we can be wrong by a substantial amount in today's markets and still smartly create trades that will make money when we're wrong. Now, again, the key to this is, hey, what if the markets fluctuate 18%, right? Then you're hosed. That's where a majority of my 5-week workshop really focuses on, is the money management, and we are going to touch on it here tonight, folks. So I'm not going to leave you hanging on that, I promise. Before we build a real trade using real data today, and talk a little bit more about the deltas and the probabilities, Tom, do you have the poll question number 2? Do you have that ready to rock and roll? Because I want to see where you're at here, folks. I want to see if you guys have, and gals have, goosebumps like I do.
I do. And here it is. What are your initial thoughts on these types of high probability opportunities? So select one from the 3 following. I love making money even when I'm wrong on direction. I prefer directional based trading where I have to be right. Don't know a thing about probability. Teach me, please. And as I see the votes just starting to trickle in here, we're in definitely a lot of you are in one of these 3 categories. Which one? Going to show you in just a few minutes. So once again, you're going to select one from the following. Once you've done that, click on the submit button. That will come back to me. What I'll do in just a few seconds is I'm going to close up the poll, and I'm going to show you the results, the overall results of this quick poll. So Devon, are we ready to close it?
Hey, if we have a majority of them in, then absolutely. Don't overthink it either, folks. Just what does your gut tell you right now with what we're looking at? And I'm going to prove that these types of trades exist today, because we're going to do it in just a minute. So
and here you go.
All right, fantastic. I love making money even when I'm wrong on direction. 73% of you. Oh man, I have a lot of like-minded people here. Number 2, I prefer directionally based trading where I have to be right. And folks, there's only 4% of you that are in that category. And let me tell you something. I'm not knocking directionally based trading or investing. I'm not. Tom, the key really is this. I mean, you know this, and so does Jay. Is the key is to be diversified in different trading systems and have a couple of 2 or 3 systems that you're really masters at. And this, in my opinion, happens to be one of the most important. And Tom, you teach some directionally based stuff, and as I said, I trade some directionally based stuff, and the key is to be able to do both, and have one work with the other. So number 3 here, don't know a thing about probability, teach me. So let's take a look at it right now, okay? Tom, if you want to put my screen back on the board here, let's go right into, let's do this. Let's go build a trade, okay? Let's go build a trade on the Russell. So what I'm going to do, I'm going to start with pulling up, this is a basic option chain with a broker called Thinkorswim. They're a subsidiary of TD Ameritrade. Now, I've already got this queued up under the trade tab to pull up the Russell. Your option chain will look the same if you use Options Express or another website, okay, or another broker, I should say, to trade off of. All right, so when we look at the Russell for the month of April, 43 days before options expiration, just about the perfect time to start trading. We have strike prices at 500. And these strike prices go all the way out here to 1700. I mean, if you count all these strike prices, there's a couple of hundred different strike prices. So, the question is, where do we start with trying to figure out where to place a high probability trade? Now, Jay asked the question via many of you is, how do you determine probability? Well, you can determine probability by looking at options delta. Okay. By the way, I have on my option chain right here the most important data to trade credit spreads with: current pricing, the delta, the volume, and open interest. This tells us exactly how many people are trading it and how many people have traded it with open positions. The delta can be converted to probability. For example, if we look at a delta of 40, and I'll cover this just real quickly here. We look at a delta of 40. We could say that this has a 40% probability of going in the money. And if it has a 40% probability of going in the money, that means it has a 60. Okay, we'll just do a little reverse engineering here. It has a 60% probability of staying out of the money. So that's how we would start looking at those probabilities. We could do the same thing with 10, right? A 10 delta has a 10% probability of going in the money, a 90% probability of going or staying out of the money. Now, I want to show you something else here as well, because we can kind of pick and choose some different strike prices and build some spreads, or we can truly work smart. And I want to go over here and I want to show you something on Tom's trading tools. If we go over to the trading tools button here, some of you may already have this. I have built a button on here. I built an area on Tom's website called the Credit Trapper. Well, let me rephrase that. Actually, I did not build it, but I helped. I contributed to it. About 2.5 years ago, Tom came to me and said, Devon, hey, wouldn't it be cool if you could take everything you do with credit spreads in terms of finding trades, managing trades, adjusting trades, buying insurance on credit spreads, and all that other stuff, and just totally automate the entire thing? And I'm like, yeah, Tom, that'd be cool, but it's not going to happen. Do you know the amount of work that would go into actually building such a creature? And he says, Devon, I've got a great software engineer, programmer. Just work with them, and let's see if we can do it. So over the course of many months, countless hours, many dollars, we have built this, and it's just one of the coolest things that I've ever seen. So I want to show you this here. If we pull up on that Credit Trapper button, we can simply look at all credit spreads for the Russell, which is already defaulted for the appropriate time. So this stuff's already done here for us. We don't have to fill in any fields. It's minimized, just the information that we need to enter. That's it. We can click on search. And I said that I was going to have you time me. So before I click on search, let me just go ahead and pull up my stopwatch here. And I said that we can find a couple of high probability trading opportunities in less than a minute. So let me queue up my watch, and let's go 3, 2, 1, start. Think, it's done. All right, 2 seconds. Tom, we beat last night. Last night it took me 3 seconds to find them. All right, so here we are. Folks, here's 2 high probability trading opportunities right here with the strike prices of 1,230.40 and 1,470 and 80. Now, this also shows us our total credit on these. We can click on the individual credit spread itself if we want to get more information on this, which quite honestly we don't need to do, but I'm just going to do it to show you here real quickly. And I've got so many things open that it's taken a few extra seconds to pull up. But this will show us our credit, $50 per contract, or 50 cents on this particular credit spread. This was a 5% return trade. But here's what we're going to do, folks. Now, I'd like you to take out a sheet of paper, because I'm sure that you're taking notes here, and I'm going to close out of this window. We're going to go over to our tablet computer, pull up a blank sheet of paper, and we're just going to write down RUT. We're going to write down the Russell. So the first trade that was on there was at the strike prices. It was a bull put spread, so 1,230, 1,240. If we were to break this down, it would be sell put at 1,240, and then buy put at a strike price of 1,230. This had if we want to get very specific about it, a 5.26% return on investment. Now, up here, we had the strike prices of 1,470, 1480, and this had a, well, if we were to break down the individual construction, it would be sell a call and buy a call option, and this has a 6.38% ROI, return on investment. Okay, now let's take this trade and kind of break it down to another step. So if we look at this ginormous trading range, by the way, okay, and let me just pull up my calculator here. So 1470, 4050, that's 230 points, right? So we have a 230-point trading range with a market that's trading at approximately 1,370-ish, okay, give or take a couple of points there. It's close to right around 1,370. So if we take 230 into 1,370, that gives us a 16.73% flux factor. Put FFB now, right? Flux factor, baby. I mean, the markets can fluctuate almost 17%. If we were to break this down to this 1,370, if we were to break this down to the distance from the current price to the puts, from the current price to the calls, this would be, 9.75% on the put side and 6.96% on the call side. So we can have a huge fluctuation in price and still have two trades, and depending on how your broker calculates margin, we can easily have a 5+% return on investment with these two trades. Now, I don't want you thinking that if we add these together, we're going to get 11%, and that's going to happen on every single trading opportunity. This is how they start out. There might be some adjustments. There's also going to be some investing into a way to protect these spreads in the event of some sort of catastrophic movement, like October 2008, catastrophic failure, or even what we've had since November 8th of 2016, where the markets decided to make a leapfrog move to the upside, 2 or 3 leapfrog moves up to the upside. We have to have a way, as good as these trades are, and they're good. I'm getting goosebumps right now just talking about them, thinking about it. As good as these trades are, we have to have a way to further reduce the risk outside of this already very safe trade. Okay, does that make sense? Well, because I don't like to lose money, and when I do, I don't like to lose very much. So it's about building a system that doesn't take a lot of time, that starts with a ultra high probability, very safe trade, and then we take it to the next level, and we manage this the best way that we know how, and then we also buy insurance on these through the use of the sibling spread called the debit spread. Okay, we'll talk more about that here in just a couple of minutes. Now, by the way, these two spreads right here, those of you that are working with me moving into next Wednesday, we are going to start off next Wednesday's class talking about these two spreads. We're going to manage these two spreads over the course of the next 5+ weeks. In addition to that, we're going to layer. We haven't even got into layering yet. We just talked about the mindset of very high probability trading opportunities. We're going to layer spreads and buy insurance around what we are starting right here tonight. So because of this time frame, near 45 days to options expiration, folks, I want to start tonight. I don't want to wait till next Wednesday. These trading opportunities are going to be the very first 2 case studies that we're going to work into next week. Okay. Now, let's go over here to oops, wrong screen here. Let's go back over to our slides, and let's talk about the problem with most credit spread systems. Many of you mentioned on the poll that you've traded credit spreads before or currently. Here's the problem with most credit spread systems. Here's a market, and let's say that you develop a way to position spreads outside of a major level of support or resistance. Let's just call this a bull put spread. We want the market to stay above this little spread here, right? And let's say that you start out with 5 contracts and you get really good at it. You start building up some confidence. And then you say, hey, I want to make more money. So now let's go to 10 contracts, right? And that works out great. Let's continue the process and earn more money. So then you go to 15 contracts, and then you go to 20 contracts. And then the markets have a catastrophic fall, and you lose on 20 contracts. This is really designed to be a losing system out of the box. And the reason for that is what I just illustrated on the board, okay? And for those of you that don't see it, is this. When you lose with a basic credit spread, you are losing with the highest amount of contracts. And when you start with an inverted reward to risk ratio, and then you talk about losing on the largest number of contracts, it doesn't pencil out at all. And that's what happened to me. You can literally trade and be profitable 11 months in a row, and then have the 12th month where you have 1 or 2 losing trades and give it all back. And that just stinks out loud. I mean, that's no fun at all. So here's what I did. I love trading credit spreads. I love the idea of knowing what my maximum profit is, what my maximum risk is, being wrong a little bit and still making money. I love that idea. Okay, I really did. But I didn't like this. I didn't like building up my contracts and then losing with always the most amount of contracts. So I got thinking, hey, what if, let me switch over to my tablet computer, instead of, here's the same scenario, instead of having 20 contracts here, what if I do this? Okay, and this is my little icon for credit spread, okay, 2 little horizontal lines, like an I, big I, uppercase I. Instead of doing 20 contracts, let's do something like this. Maybe let's only trade 5. But let's do that 5 contracts over multiple areas on the chart. And let's do this 5 contracts on the upside as well. Now, is that going to prevent the markets from making a catastrophic move to the downside? The answer is no. Or even a smaller move, medium-sized move to the downside? The answer is no. It's not going to prevent it. But if we take a little bit more effort and we work into these maybe every week instead of once a month, and we do it with smaller amounts of contracts when we're wrong, okay, look at the little illustration on the board. If we're wrong on this example, right, would you rather lose on 20 contracts, or would you rather lose on 5 and have 5, 10, 15, 20, 25, 30 profitable contracts to offset that loss? So that was the idea that first came to me back in, gosh darn it, it's been like 2006, early part of 2006, I think is when it was. And so I started a quest to layer. I didn't know it was going to be called layering at the time, but how do I take a basic credit spread or iron condor system and turn it into something that's better? And this is what I've come up with. And this has been an 11-year, 10-plus year work in the making, and I still refine it. I've made some awesome changes to it, the system here this last year, which we'll talk about as well in just a few minutes. Now, Jay, I'm sure you get some answer or some questions. Hey, Devon, aren't we paying more money in commissions by layering versus not layering? The answer to that, I want to address it right now. The answer to that is yes, we are, okay? But let's talk about commissions. I mean, commissions are so stinking small right now compared to what they used to be. In fact, many of you, if you're trading with TD Ameritrade or Thinkorswim, you probably just got an email I think it was 3 days ago, saying, congratulations, because you're a client, your commissions are dropping. Commissions now with TD Ameritrade is $6.95 for up to 10 contracts, right? With many of your other brokers like Options Express, I mean, they're right there as well. The average commission now is less than $10 for an online trade, for an online options order. So even though we're paying a little bit extra money in commissions, we're not paying a whole heck of a lot. And look at this example. With these bull put spreads, instead of trading 1, we are trading 4. So technically, we are paying an extra fee on 3 trades because we would have done 1 anyway, right? So if we're paying $7 times 3, we're paying an extra $21, big whoop-de-doo-dah, to have significantly lower risk. I mean, it doesn't make sense not to do this, in my opinion. So yes, we do pay extra money in commissions, but they're so stinking small, it doesn't really matter. So this is really, folks, this is the start of the layering system right here. So what is layering? Okay, you're going to want to write this down. Layering is this. Layering is adding multiple credit spreads over different time frames to bring in cash flow, and this is the biggest part, okay? Remember, it's all about reducing risk. I can show you how to open up credit spreads. I mean, you'll know how to do it by the end of next week. The manual way and the automated way. It doesn't take that long to learn it. It's the money management, okay? So adding multiple credit spreads over different time frames to bring in cash flow and to help reduce the overall risk of our credit spreads. That is key. That is absolutely key. Money management, credit spread management, whatever you want to call it. That separates the decent traders from the really good ones. And that's why, really 4 of the 5 weeks that you're going to be working with me are talking about money management, because you'll know how to open a 92% probability trade manually by the end of next week. I'll even show you how to place the trades online. All right. Now, another just quick little comment. This works best on individual markets or individual index markets, markets like the Russell, markets like the S&P, SPX. This does not work very well on individual stocks. Stocks like Apple, even these expensive stocks, or Chipotle Mexican Grill, Tesla, it doesn't work very well on. And the reason for that, in the most simplest terms, is volume and open interest. There's a whole heck of a lot more volume and open interest on the index markets than there is on individual stocks, which allows us to layer. There's also another key element. There's no earnings on the indices like there is on individual stocks. But above that, we'll get into this more when we start talking about the ATR and the average trading range, is that there's lower volatility on the index fluctuation of price, but there's higher volatility in the index options pricing. So going back to trading probabilities and setting ourselves up for success right out of the box, we want to trade the best instruments possible. And just by simply trading an index, we're putting ourselves already on the right side of that trade. Okay. So, all right, we already touched base on that. Doesn't work very well on individual stocks. So, in a perfect world, basic credit spread entry times, 45, 30, 20 days before expiration. Okay, these are average times. These are what I refer to as recipes. And the reality is, folks, we can enter credit spread layers anytime, all right? Sorry, my writing's a little sloppy there, writing on a horizontal screen. Anytime between 20 and 45 days before options expiration. I just put days X, okay? 20 to 45 days before options expiration. This is why this is the perfect time right now. We are right here, near that 45-day mark. What we're going to do for the next 25 days is we're going to layer around those 2 spreads that we've already found here this evening. And then as we get close to this 20-day mark, guess what's going to be coming up? May. And then I'll show you how to start 45 days before May and layer 2 months worth of the same market trades. Now some of you can start to see why, hey, we don't need to learn 10 different markets. We need to learn one. Not only do we need to learn one, we need to be nice to it, right? We need to develop a relationship with the Russell. Now I know that sounds kind of funny, right? Develop a relationship with the market. What the heck are you talking about? We need to understand how the volatility works, how the volatility moves, understand how long an average trade fill takes, and build confidence with that, because for most of you folks, the Russell will provide more opportunities than you have money, especially if you start to scale some contracts. There's a lot of volume and open interest there. There's a lot of opportunity on the Russell. We don't need to look very far. Even me today, quite honestly, the credit spreads that I look at are primarily on the Russell, occasionally on the S&P. Okay, occasionally on the S&P, but Russell's my favorite by far. Let's take a look at how this looks in a perfect world. Now, the world is not perfect very often in the credit spread world, in the layering world. So I'm going to show you PowerPoints on a perfect world, and then we'll switch over the tablet computer and talk about a non-perfect or normal market, right? So 45 days before options expiration. We're looking for a bull put spread and a bear call spread exactly like we just found a few minutes ago. We want the markets to stay in this ginormous trading range. Okay, we open them up. As we get closer to options expiration, we look to open another couple of spreads. They're going to be a little bit closer to the current Russell price. because naturally we're going to have some time value that has depreciated. Essentially, that's what we're selling, right? Then as we get even a little bit closer, we're going to look to sell, if possible, another couple of spreads. This is how the markets look in a perfect world. For the March expiration, we've actually had 5 bull put spreads that we were able to open, and I think we had 4 bear call spreads, substantially more than what I'm showing you here. So it does vary a little bit. Usually getting 3 bull put spreads on even the lowest volatility non-moving markets pretty easy. Usually worst case scenario, there's been a couple exceptions, but usually we'll get 2 to 3 on the call side, okay, over a month's period of time, 25 days period of time. So a non-perfect world, this is how it's going to look. Let's say this is our market, okay, where we're at right now, right? We've gone up, kind of going sideways. The Russell seems to be locked in about a 75-point trading range. If we look at a chart on the Russell, if we look at, and here it is right here on your screen, folks, if we look at the lows to the highs, we seem to be in this 75-point trading range, okay, thereabouts. So how do we trade this if the market's going up, okay, like they did here November, December? So what we would do 45 days before options expiration, we would open up the same type of trade, okay? I'm just going to put 45 next to that. I know that looks kind of like 95. Let me just modify that. And there we go. 45 days before options expiration. Markets trend higher. Then what we do is we look to open another set of layers, but the layers are going to start climbing. Okay, markets go a little bit higher. We're going to open another set of layers, and I'm running out of room on my computer screen here. But what's going to happen? You will see that there might be a trade that is going to get mighty close to the Russell. And what I'm going to teach you how to do, what we're going to do together, is we're going to learn how to do something with those trades in danger. We're going to learn how to make adjustments to trades as the probabilities drop. So here's a very, very key point of a piece of information. We're going to open spreads at a 92% probability. We are going to adjust, okay, and now I'm not going to say close. We're going to adjust our credit spreads when and if the probabilities drop below 80%. Okay, so we're not going to mess around with 50% stuff. We're not even messing around with 65 or 70% stuff. I'm talking 80. So if that probability drops below 80%, we are going to do something with the spread. It's not worth the risk because we have an inverted reward to risk ratio. Right? Remember earlier I said, hey, if you bought Starbucks at $55 per share and it starts to go into a catastrophic drop, what are you going to do? You're going to let it go all the way down to zero? No, that's pretty unlikely. The answer is no. No, you should do something to it, right? True with any of your directionally based trading opportunities. So if this spread, or any spread, if the probability starts dropping below 80% that we can measure, we're going to do something with the trade. We're not going to get anywhere near the fire. This reduces stress significantly. It also reduces the cost to buy these back, to adjust them, to roll them out. It makes it a lot more efficient to do. Okay, that's how it would look in a trending market. Consistency is the name of the game. Okay, if there's one word that would apply to any trading or investing system, it is this word right here, consistency. We want to have consistent profits. We want to have consistent losses. Okay, now let's complete those two. We want to have consistent profits that are higher than, that are greater than our consistent small losses. Okay, we want consistent higher profits, right, and smaller losses. Now, what I want to do is share with you some of our case studies that I've done with Tom's groups. One of the things we do, we start layering right out of the gate. We've done that tonight. We're going to carry it into next week. And at the end of our 5 weeks together, starting next 5 weeks, starting next Wednesday, we're going to audit all of our trades, and we're going to take a look at what was the total return on investment. Sometimes there was a little bit too much insurance that was bought. Sometimes we had an adjustment. Sometimes we had a losing trade. Okay, so that all goes and plays into the actual return on investment. But nonetheless, let's take a look at consistency. Okay, these are trades here with the profit. So $500 profit, $450 profit, $520, $450, so on and so forth. So they're all about the same. And there's some insurance right here as well, which happens to be kind of a chunky piece of the pie. However, it's been an absolute game changer, in my opinion, since I have really refined the insurance rules back in 2010. And I've refined it once again here just this last year as the markets have changed slightly since November. But nonetheless, this gives us a profit, $2,540. Is that good? Is it bad? It kind of goes down to return on investment. Well, that works out to be about an 8.6% return on investment. Now, keep in mind, I was showing you a 5% trade and a 5% trade and talking about a 10% return on investment. There was a purchase of some insurance, which I'll talk about here in just a few minutes. I definitely want to get into that topic. And not only that, but it also depends on, sometimes we might have 5 bull put spreads and maybe only 2 bear call spreads. Maybe that's how the markets line up for that particular month. So we're not able to use what's called that double margining on every single credit spread. Therefore, we're not able to combine return on investments on every single trade. Now, that kind of opens up a whole other topic right there. If we had 2 bear call spreads and 5 bull put spreads, we'd only be able to combine on 2. Whatever your smallest side is what you can combine. But nonetheless, it's 8.6%, which is not too bad over 5 weeks of looking at the markets once a week, being stress-free. The markets move a couple, 200-300 points in a day, saying, what the heck, let's go grab coffee. We're nowhere near the fire, and living life, right? Taking kids to school, going fishing, taking your time, and because this should only take you an hour a week at the most after you go through my training. My goal is to have you 2 months after going through the training being able to do this 15 to 20 minutes a week, and it's very doable. Okay, some of you might be 30 minutes, but nonetheless, it's not going to be a huge time commitment per week. Let's take a look at some other trades. This was from another class I did with Tom. I've over the last 2 years, I've done 2 of these 5-week workshops with Tom. That's it. I do this once a year, folks. That's it. Back in the old days, I used to travel 50 plus times out of the Portland airport. I used to do 3 or 4 of these per year online. I just don't have the time. I am a investor. This particular system is part of my investing umbrella. And I do a lot of fishing. I do a lot of camping. I spend a lot of time with the kids. I spend a lot of time with the kids camping. I spend a lot of time with the kids fishing. I spend a lot of time with the kids camping and fishing together. So amongst other things. So I do this once a year, and this is right now. So here's some other trades from a previous year, but I want you to look at these, the profits per 10 contracts. They're about the same, right? 570, 700, that was a little higher. 550, 500, 600, 500. If we go back, and there's no losses on these, we have 520, 450, 500, 600. If we were to average these, they would be pretty stinking close to being about the same. Now, for the second group of trades that I'm showing you here, and there's a little bit more money with insurance that was spent. Again, I'll talk more about that here in a minute. That's just how the markets worked out. There's a very, very specific way to buy insurance. And I'm not talking like Geico or State Farm, but I'm talking about using options creatively to go out there and position other spreads like debit spreads to essentially act like an insurance policy, so when we're wrong, we further reduce our losses. We prevent major catastrophic losses. So this particular series of trades only produced about a 3% return on investment. We had substantially more bullish trades than we did bearish trades at one particular time that was open. The insurance cost a little bit more, and so on. If we take all these case studies over this 5-week period of time, these 2 5-week periods of time, and average them to a month, they're 4.98%. Call it 5% return on all of these case studies. Is that what we're going to do moving forward into April's expiration? I want to make it very clear. I have no idea. One thing I will promise you, though, is that we are going to go through and we are going to audit all of these trades that we do. This is a sample over 2 months. And when we start doing these trades, folks, and we started tonight, and when we start really building these layers moving forward, and we start looking at additional case studies next Wednesday and the Wednesday after that, that's going to be the first thing we do every week. We're going to manage the current trades that we have, and we're going to find new trading opportunities. Each week, that process will progressively get a little bit longer because we're going to have more layers. Each week, we should have at least one additional layer to go out there and manage. And that's, designed that way to help you kind of work into doing this on your own so you can pick up where I leave off. But I do want to mention one thing, as we go through this in the class next week, folks, please make sure that you are paper trading these and not live trading them. And I'll tell you why. Because we're going to spend at least 4 weeks going through learning about money management techniques. And my concern is always that you have the highest probability of picking up where we leave off. If we have some wild, crazy moves going into week 3, for example, or week number 2, for example, and you have a real credit spread that's open and we haven't got to some more detailed insurance buying and money management adjusting, and then you have a trade that's starting to lose money, you're not going to focus on the class, and you're going to get discouraged. So please see the whole movie before you start doing live trading, okay? It's very, very important. The first steps that you take are absolutely the most critical. And so I need you to paper trade those and follow those. Make sure you have a really good understanding, and providing that you do the homework that I give you, because it is a very interactive class, that you will be able to pick up, should be able to pick up exactly where we leave off. So let's talk about the 2 keys to trading credit spreads. Okay, we've talked about one already. Okay, we're going to touch on the other. Number 1, proper order placement. That's the goosebump types of trades, right? 92% probability trades, very, very high flux factor, right? 20 to 45 days before options expiration. That is key. All right, and we can even go down to money management and say, hey, the first rule of money management is this. The first rule of money management is positioning credit spreads so we don't have to adjust them very often. That's the first rule, right? We don't want to crash the car too often, right? So, but when there is a stronger, longer directionally based move on a credit spread, the losses can be greater on a percentage basis, let's say, than a directionally based trade. And that's why this is so darn important. So some of the things that we're going to do is this. We're going to learn a couple of key things. Number 1, what I call delta adjustments. Now, delta adjustments, we learned a little bit tonight. This could be converted into another word, right? Probability. Okay, delta, probability, essentially they're the same thing. I've called them delta adjustments forever, so I still call them delta adjustments. That delta adjustment is going to move into really what I call an all-in-one adjustment. It's worked really well over the last few years, and it simplifies the process. It takes just a lot of the stress right out of the system, so we adjust once instead of maybe 2 or 3 times in a period where we have to adjust. But we're going to spend a lot of time as well on insurance, okay? Using debit spreads, using some of the profits, the maximum profits from the credit spreads to purchase debit spreads in case we have some sort of a strong directionally based move. Now let me switch over to the tablet computer. I just want to scratch this down on a sheet of paper. Okay, now this is going to take a few weeks of introducing part of it, looking at some data samples, giving you some homework, having you maybe even follow a little bit, having me help pick you back up, and then getting you to the next level, okay, and working through this together. But I want you to see the concept of this. So tonight we have looked at a bear call spread and a bull put spread, right? And those were at the strike prices of down here at 1,240, right, 1,230, and on the bear call spread was up here at 1,470, 1,480. So what we're going to learn to do 45 days before options expiration, and this part we're going to leave out tonight, but what we're going to learn how to do is take these maximum profits. Maybe on 10 contracts, they were $600 on top and $500 on the bottom. But we're going to take those potential profits and we're going to invest in a couple of debit spreads, okay, on both sides of the market. Now, these are going to be at very, very specific points based upon probabilities and deltas, okay? Same, word essentially interchanged there. We're going to essentially, at 45 days before options expiration, we're going to be at a break even. We're going to invest the entire maximum profit. Over the next 25 days, what we are going to do, and I'll use my green pen here, is we're going to layer, in a perfect world, we're going to layer our other credit spreads. Okay, it might look something like this. Our other credit spreads are essentially going to, in most cases, there's an exception, but in most cases, our additional credit spreads are going to feed off of these insurance policies that were already created with the original layer. And the cool thing about this, folks, is if we get some sort of a directionally based move, not only have we separated our risk amongst our credit spread layers, but we've also positioned a directionally based trade that's paid for by the first layer that in most cases is going to be generating profits and helping us offset our already reduced losses. Now, to come up with exactly the placement of these folks, it has taken me from 2006 to the start of 2011. It's taken me a long time to figure out what's the best combination of opening, closing, and adding insurance. It's taken me a long time to figure this out and get something that's very, very simple and repeatable. Something that I can turn into a system, a repeatable set of rules. And right now, I expect some of you, many of you, as a matter of fact, to be overwhelmed with what I'm putting on the board. Now, back in the old days, I only used to teach live classes, and I'd present this. In fact, Tom and I have taught this, I remember in Las Vegas, amongst other places. I would teach this over the course of 2 days on a weekend. Quite honestly, the retention rate with our students back then is just not that great. Now, doing this online, like we're starting here this evening, and taking this idea and breaking it down over the course of 5 or 6 weeks, and having you just learning a little piece of it every week, and then having you do something every week and getting involved with it, the retention rate has gone through the roof. And that's why today I refuse to teach this live anymore. I only teach this online because we can do the layers as they happen. We can make the adjustments together as they happen. We can add insurance together as it should be added, and then you simply pick up right where we leave off at the end of the workshop series, and go from there. Now I want to show you something else, because we can look at deltas. We can go over here to our option chains, and we can look at the deltas and the probabilities, and we can look at different areas to buy insurance. I'm going to teach you how to do this the old school way. I'm going to teach you how to do this by hand. You'll learn it next week. I'm also going to teach you how to push a button. You'll learn 2 ways to do it, okay? Modern and other. What Tom and I have put together is really, really awesome, because what we can do is type in what our average credit is, right? We had a $600 credit on 10 contracts tonight that we featured, and a $500 credit. Average the two, it's $550. We can type that in. We can click on Find Insurance, and we can click on Search, and it'll tell us exactly what our insurance spreads are, how many contracts that we should buy, and exactly what the price is that we should buy them at. I just made one little mistake here, however, and that is I need to select April and not March. Let me redo that here just for the recording. It takes just a second, right? So much better. We look at our April spreads. At least I didn't do that by hand. That would have just, I would have burnt probably 10 minutes of my time. So now it tells me that I need to buy 13 contracts at $14.90, $14.50, and gives me the price and all that other fun stuff. So by this insurance spread, this insurance finder It's just super, super cool. It takes this more complex issue of buying insurance and it simplifies it. Folks, even if you've never traded a credit spread before, even if that's you, you could look at these strike prices, go over to your broker, pardon me, and with that primer video that Tom's going to send out to you, for those of you that are registered for my workshop, you can go right to the strike prices and match them up. And it's really that simple. And there's something else I want to show you too. And this is going to go over some of your heads, but I want to show it to you anyway. Because with the adjustments, we've even built, let me just go over here, an adjuster. If I click on search, it's going to allow me to select the options expiration period I want to look at. I can do that. And this is going to pull up a chart. I'm a very visual person, as most people are, and if you're not, you can read data, excuse me, you can read data in the legend here. And it tells me exactly where 80% probability is and where 92% probability is. Okay? Now, this 92% probability is the blue line. Those are the spreads that we featured tonight, right? Right here at 1460 and 1240. Now, we know where 80% probability is today. It's at 1300. Okay, so we could say, you know, in the next day or so, if the Russell were to fall from a price of 1374, 75-ish down to 1300, if the Russell were to go down approximately 70 points from today's close, then the probability would drop from 92% to 80. It's going to take a pretty substantial move. Now, on the upside, it's always a little bit less. So if the Russell were to go up here to a price of 1440, that's 70 points. If the Russell were to go up 70 points, okay, by the way, outside of all support resistance lines, if the Russell were to go up 70 points, the probability would drop to 20%. And we can do that by looking at an option chain and looking at deltas and doing some manual calculations. Okay, so next week we will look at both ways of doing this. There is a lot of value